Did you know that if you search for market crash in YouTube, these days pretty much everything is about Trump? What the fuck, man? Does that mean I have to sell all my shit if Trump wins? What's going on? Well, some people have been predicting that due to the uncertainty of Trump's economic policies, if he wins, the market's gonna take a dive. Alright, radical. What are you gonna do? The answer's pretty simple. Buy the fucking dip. Here is Brexit. Remember Brexit? The UK, they're going to leave the European Union. Oh no. Oh shit. What does that mean? Does that change anything about the companies? Does it change anything about... What are some of them UK stocks we got? BP? I can only think of BP at the moment. But look, it's a fucking dip, dude. 2-day dip. Should have bought the dip. Here's BP. Oh, there you go. A dip. Wow. People panic for a couple days, and then they realize there's no reason to sell things. What happens when the UK leaves the European Union? Nothing really. They have to talk about how things are going to change for about a year before anything actually happens. So why sell your stocks? Now, if Trump wins, what happens? Well, instead of an out-of-touch old woman getting into office, we have an out-of-touch old man. Does that really matter? Do the companies actually change? Look at this. You might think, okay, the SPY bounced back because the SPY is part of the US. That's a US ETF. Well, let's take a look at the, what's the UK one? EWU? Oh, look. You should have bought the fucking dip. Bounce back. You just buy the dip, man. It's so easy. If people panic and they sell this stuff because they think Trump is the next Hitler, you should be happy. Because you got a chance to buy the dip. Now, that's assuming you think the market's going to continue upward. If you think it's going to go sideways, well, plan accordingly. But if you're not even trading directionally, you can still play the Brexit is going to happen. Trump is going to become president angle. Check this out. Look down here. I'll pull it up to make it bigger. Look down here at the volatility charts. See implied volatility and statistical volatility? Alright, so... Brexit. Here's Brexit right here. You see how statistical volatility jumped up? Implied volatility fell? You can trade that volatility on this. This is going to be the same situation for Trump if he wins. Alright? Now, the issue is the same. And it will look... Actually, the charts will look pretty much exactly the same. I'll tell you why. Nobody expected Brexit to succeed. So even though volatility rose, at the end of it, people were like, it's not a big deal. Brexit's not going to go through. Volatility fell. That was a prime opportunity to buy put options. Because when the implied volatility is higher than the statistical volatility, options are at a discount. Sorry, they're at it. I was wrong. They're not at a discount. They are at a premium. So that was the perfect time to sell spreads. Now, because you knew that, well, you would speculate that if Brexit didn't go through, the market probably wouldn't rally because it was pricing in a non-Brexit, a no Brexit, Nexit. In that case, if it's already priced in, you know that it's not going to rally. So what you can do is you can sell the credit spreads in the bullish direction. I'll show you how that works. Let's go into whatever options program you got. Choose a vertical spread. And you're going to choose a vertical spread that's at a credit. Now, if you're in the bearish direction, if you think things are going to fall, or you think it's more likely to fall, or you think that it's going to fall or trend sideways, those are all fine times to play this. What you do is you sell a call, and you buy another call. Open for me. There we go. So you're going to buy actually the higher strike price, and you're going to sell the lower strike price. You're going to get a net credit. So as soon as you open that trade, you've made $400 essentially. And if you're right, you get to keep that $400. If you're wrong, you lose the difference between the strike prices. If it rallies all the way upward. If you're wrong and it trends sideways, you still make money. Now, when options are expensive, you can do this and make a lot of money. When options are not expensive, afterward, that's when you can buy long options. So, based on this volatility chart, what would have been the best play for Brexit? Well, going into Brexit, you take the safe choice. You know it's not going to rally. It might fall. It might trend sideways. Therefore, you're probably going to want to run a credit spread, a bearish credit spread. So you do that. Then when these two volatility lines cross, you close your position. You take your profit and you switch. You presume that the market's going to bounce back and you buy call options. And you would have made money because call options would have been discounted at this time. But as we saw, if you bought the dip, you were smart. You would have made money. Same thing with Trump. We're going to see this same kind of volatility trend. It's going to rise into the election. As we get closer to the election and people get more data from exit polls and they find that it's very unlikely Trump will win, that volatility is going to fall. You've already locked in the high volatility through that credit spread. If he wins, you get to keep that profit, and then you're going to see these lines cross. Wait a couple days, see if you hit a bottom. Of course, you can never tell if you hit a bottom, but you get the idea. Everything is going to be overvalued. The fact that Trump controls 1/3 of the U.S. government doesn't change the fact that Microsoft is beating all its competition in enterprise cloud. All right? It doesn't matter. So, what are you going to do? You're going to buy the fucking dip. That's it. Buy the fucking dip.